All of us are familiar with his tales of triumph, his brilliant investments, and his remarkable market forecasting abilities. However, what about his shortcomings? You read it correctly. Even Warren Buffett, the famed investor, is not immune to making mistakes. Hello and welcome back to our channel. Today, we're going to talk about the Oracle of Omaha and how even arguably the greatest investor on the planet made mistakes, and what we can learn from these mistakes. So let us begin. You've probably heard of the money Warren Buffett made by investing in huge companies like Coca-Cola, American Express, Apple, Bank of America, Moody's, and Kraft Heinz. The legendary investor is more than $100 billion rich and is revered and admired all around the world. Warren Buffett's appeal, though, goes far beyond his financial savvy. To paraphrase one of his most famous quotes, "It's good to learn from your mistakes, but it's better to learn from other people's mistakes." Let's go on an adventure into Buffett's investment world using his own words as a map to discover more of his huge mistakes. We'll analyze these mistakes in order to learn something that can help us in the future. Buying Dexter Shoe Company. Berkshire Hathaway's purchase of the Dexter Shoe Company in 1993 was the move most deeply regretted by Buffett. However, the project fell apart due to a number of serious mistakes. First, Buffett underestimated Dexter's potential. His primary motivation for purchasing Dexter was its high return on invested capital. He paid little attention to the growing challenges posed by competitors such as the flood of low-price shoes from China. In 1999, Buffett pointed out the difficulty domestic shoe manufacturers were having due to the fact that a staggering 93% of the 1.3 billion pairs of shoes sold in the United States were imported. The first thing you should do before putting your money into a firm is to figure out what sets it apart from the competition. Having the ability to remain competitive over time is crucial for any company hoping to thrive in today's fast-paced industry. The second error Buffett made was in the way he made the acquisition. He paid $433 million for Dexter in Berkshire Hathaway shares rather than cash. In 1993, one share of Berkshire's Class A stock was worth about $15,000. Today, the same share is worth a whopping $517,000. As a result, Berkshire shareholders lost more than the initial $433 million invested in a company that ultimately achieved zero success due to the Dexter catastrophe. Instead, they lost an eye-popping $15 billion because they sold stock that would have greatly increased in value had they held on to it. Buying Berkshire Hathaway. During a 2010 interview with CNBC, Buffett famously called Berkshire Hathaway the dumbest stock I ever bought. The story began in 1962 when Buffett made an investment in a textile firm that was experiencing financial difficulties. At the price of $11.50 per share, he had agreed to sell his stock back to the company's owner, Seabury Stanton. However, when Buffett got the offer letter from Stanton, the price had dropped to an astonishing $11.38. Buffett felt wronged and made up his mind to get even. Instead of selling, he began buying more shares of stock to the company, eventually becoming CEO and forcing Stanton out. If he had sold at the agreed-upon price, he could have put the money back into the insurance business. This is the road he would go down, the foundation upon which his business will be built. Instead, he had to put his energy into trying to save a failing textile company. The mistake has cost Buffett dearly. As he reflected, "I had now committed a major amount of money to a terrible business." He figured he lost almost $200 billion because of this mistake. While it's unlikely that you'd buy a company out of spite, investing decisions can still be influenced by how you feel. You may feel everything from excitement at the prospect of making a fortune to fear as a result of a failing market and the potential damage to your investment account. Rather than reacting to the minute-to-minute fluctuations in the market, investors would do well to take a deep breath and remember that their investments are meant to grow in value over time. Investing successfully, as described by Sam Stovall, chief investment strategist at CFRA, is about teaching yourself not to let your emotions become your portfolio's worst enemy. Successful investing requires a cool head and time, not impulse. Energy Future Holdings. Warren Buffett and Charlie Munger have built a reputation as a powerful investment duo because of the invaluable input of both individuals. But in his 2013 shareholder letter, Buffett did something on his own. This single risky business move was the acquisition of $2.1 billion in bonds from Energy Future Holdings Corporation, which led to a devastating $873 million loss. Coal-fired power facilities were the sole source of electricity for Energy Future Holdings. Buffett's 2007 purchase of their high-yield bonds was predicated on his expectation that rising natural gas prices would benefit the company's coal-based operations. When natural gas prices collapsed from their 2007 highs, As he said they would, energy futures suffered significant losses. In 2014, the company's financial difficulties became too great to ignore. As a result, Berkshire lost $873 million when it sold bonds worth $2.1 billion in 2013. After giving it some thought, Buffett concluded that he had incorrectly assessed the investment risk and potential return. He stressed the value of consulting on a colleague or close friend for advice before making a life-altering choice. There are a few lessons that can be learned by investors from their misadventure. The first thing it does is stress the difficulty of producing accurate forecasts, especially when those forecasts are tied to variables that are subject to significant swings, like the price of natural gas, oil, gold, or even individual stocks. Second, the lessons to be learned from Buffett's experience should temper the appeal of high-yield junk bonds. Large companies like Berkshire Hathaway can afford to take some hits when they pursue high-risk, high-reward possibilities, but for individual investors, the consequences of a default can be catastrophic. Therefore, it is critical to avoid investments with questionable returns. Berkshire Hathaway had a $2.3 billion interest, or 515 million shares, in the UK-based grocery company Tesco as of the end of 2012. In his 2014 shareholder letter, Buffett disclosed that he had lost faith in the company and sold 144 million shares over the course of the next year. Buffett is well known as an investor because of his ability to buy shares in successful firms and hang on to them for long periods of time. Tesco, however, started to have structural issues. According to Buffett, Tesco's issues multiplied during 2014. The company's market share shrank, profit margins narrowed, and accounting irregularities surfaced. As he elaborated, in the business world, bad news often comes in waves. You spot a single cockroach in your kitchen, only to discover its extended family in the ensuing days. Berkshire eventually sold its remaining Tesco shares, incurring $444 million losses. While thinking about the mistake, Buffett reflected, "An alert investor, I regret to admit, would have offloaded Tesco shares sooner. By procrastinating, I made a serious mistake with my investment." Even the most astute investors sometimes have trouble letting go of stocks they once loved but are now underperforming. Scott Nations, president of Nation Shares, a firm that analyzes investing volatility and author of the book The Anxious Investor, attributes this aversion to a cognitive bias known as anchoring. He elaborated, "If you purchase an investment at a certain price and its value has since dropped by 20%, it's difficult to shake the belief that it's still worth the original price. The inclination is to hold on and put off doing a reevaluation and possibly selling off the investment. Nations suggests selling off a piece of such an investment, which is what Buffett did. This can help dispel any false notions of the investment's value and pave the way for a clearer assessment of its prospective returns in the long run." Buffett did the right thing in this regard, although the timing wasn't to his liking. So that was all the time we had today, folks. Hope you enjoyed the video. Don't forget to subscribe to the channel and hit the bell icon on your way out. See you all next time.